In this video, we're going to discuss how do you calculate the return on invested capital when a brokerage firm allows you to have what's referred to as a margin account. And a margin account essentially allows you to borrow money in order to invest in securities. So let's start. If you invest $100, or if you're going to buy 100 shares of stock, let's say that the stock is worth $100. Now, if you just wanted to buy the stock, you could buy the stock for $100 times 100. That'd be $10,000. What if the stock went to $105? Well, so here we have $105. The value of the portfolio went to $10,500. Right? And what we can see is that there's obviously going to be a rate of return. Now, first, actually, here's the return without margin is this 5% return, right? I mean, 105 divided by 100, 5%. So let's assume, though, that the brokerage firm is going to allow you to open a margin account. And the margin is the equity. In other words, the initial margin percentage is how much money you have to give in order to purchase this investment. So if they say, look, we'll give you a 40% margin account, that means, if you look to the right here, you're going to have to give them $4,000. That means you're going to borrow $6,000. And for that particular investment, again, you can see that without the margin, you made 5%. But our return on invested capital, at least at this point, tells us that this return earns about 12.5%. So the first thing we can see is that a margin account will allow you to magnify the returns that you ultimately earn on your investment. So now let's think a little bit further now. When you have a margin account, you're also going to need some other information. The first thing we should probably add to this is, well, how long am I going to own this investment? And let's just make it 3 years. Let's assume that the interest on this borrowed money will make it 4.25%. And let's assume that the brokerage account will allow us to lose some money, right? We can lose money, but before we have to, again, kind of surrender more investment, if you will. So in other words, the brokerage account says, look, if your ownership falls below 30%, that's what this maintenance margin is. If your account falls below this 30%, we're going to require you to give us some money. And that's what it's referred to as is a margin call. So let's kind of look at some of the information we have here, and then we'll add dividends. You can see that, again, for this, the return that we had, because we've added interest, that lowered our return a little bit, right? So now we're down to negative 2.65% because we had to pay interest on this margin account. Now, even though we made money, we lost money, right? We lost money because of all the expenses. So if this went to $110, you now see the what? Now we made some money. It has to go up enough, not just to obviously higher than the purchase price, but now we have to exceed the interest that was paid. In this case, there was $765 is the interest that was paid over this 3-year window. So now let's go back to here. We have back to our $105. So we have that information in there. And again, you can see here that when we add the years, we can now annualize this. And there's two numbers. There's an approximation number, and then there's the time value number. The time value number will be the exact number. And depending on the problem and depending on how accurate you need to be, you can see that the numbers are pretty close together. So the only thing, two questions we're going to add is, what happens if dividends are paid? So let's assume that I get $1 dividend on each share per year. So $1 times 100, that's $100 per share per year, 3 years. That means we're going to have $300 in dividends. And let's make that number a little bit better. Let's just say in the end, we're going to get $600 in dividends. So what you can see now is if we don't have a margin, we actually would make money. Now we're going to be able to offset some of the interest expense with dividends. So now we also see that across the board, now this investment is going to make money. 8.375 is the return on invested capital. But when we annualize that, you see we're down to about 2.7% is the annualized rate of return on average per year. So what other questions can we ask? Well, a good question might be is, well, wait a minute. Before I go further, if you notice down here, here's the current margins, 42.85%. So that means what? We own 42%. Maintenance margin says you can go as low as 30%. So the amount required for a margin call is a negative number right now. A negative number here means that there's no call that's required. Well, that's fine. So how low does it have to go before we would have a margin call? So if it went to $100, that didn't change it. We need to actually lose some money on our investment. So let's say it goes to $90. You can see it's still negative. The current margin's 33%. So let's go to $85. Now at $85, what you see is what? That the current margin now is 29%, lower than 30%. So they're going to ask us to invest $50 into this account. And that's fine and dandy. This happens from time to time. It's just what's referred to as a margin call. And of course, that $50 is only going to bring you up to 30%. So now we have to worry about, well, what happens if the price continues to fall? We'll continue to have margin calls. Now, there is a way to exactly find the stock price that would trigger the margin call. And how we would do this, we would use the solver from Excel to solve for this particular question. So if you go up, and I'm going to choose the data, I have solver chosen here. You can't see this. If you don't have this, you go to the options section of Excel, and it will help you add in the Excel data plans here. And here we have our plan. What we want to do is I want to set this current margin. I want to make sure that it has a value of, and what I've entered here is I've added the maintenance margin. So I want the current margin to equal 30%. And I want to find out by changing the value. I'm going to change this cell here. If you see here, that's cell E12. I want to change that cell. So when you solve for this, if you click on solve, it tells you found a solution. And now you'll see that the price here, it changed to $85.71. That makes the current margin 30%. Any price less than this value will trigger a margin call. So again, let's go back to our 105, so we're even, and we understand this is where we started. You can see there's some interesting questions that can be answered. You can also solve this information for short sales. Change the long position here to a short, enter the data that you have, and it will actually calculate the returns you have or need for the short sales. And that's the end of this video. I hope it was helpful.